Welcome to The Real Money Show, the number 18778 Silver, and the website guildhallwealth.com. Today on the show, we're going to talk about some stories of the weeks, some top stories. We've got a great article that was put out in the Globe and Mail, which we'd like to push back on. A gentleman at the Globe and Mail is talking about why he says no to gold and his reasons, and we're gonna talk about some of those reasons and why we think he's incorrect. So stay tuned for that. Coming up in the show, we're also going to talk about some of the big heavyweights that are moving into the precious metals market, and of course some Q&A. We've got some Q&A from our clients. Again, the number 18778 Silver and the website guildhallwealth.com. My name is Jeremy Wiseman. Joining me today is Jerry Correia. Jerry, how was your week?
Busy, Jeremy, but I feel good. It was a good week. How was yours?
It was great. One of the things that was really great about it is, as you know, Jerry, over the course of definitely the last year, maybe even a little bit more than that, I've noticed that the people who were coming into the office and the people that we were speaking to felt alone in what their thoughts were. We do deal in fundamentals, and part of the fundamentals in our market is, supply and demand on gold and silver, inflation or dollar devaluation leading to inflation, and of course geopolitics, which comes out of all of this money printing and the lack of trust that happens, and what kind of geopolitics can come out of that. And so I've noticed over the last year, people really want to talk about that. They want to talk about what's going on with the pandemic. They want to talking about what's going on with the government, and they felt very separated from a lot of people.
True.
And that's why I think many Canadians are very excited about the truckers' convoy, and it's been great to hear it on mainstream radio in many respects. It's something that they're talking about, and there's a lot of things talking. So I thought I would just quickly share some of my points about it, sort of my personal takeaways, and then of course you let me know what yours are as well.
Interesting.
So again, one of the things is just the fact that people have really, again, in our business, they felt alone from their families. They don't want to talk about things. They can see how the mainstream is treating it. And I think that they finally have a voice. And that's one of the things that's great. Like even watching mainstream, listening to the talking to the government and journalists talking, it just seems that everyone has a lot more courage and a lot more voices coming forward. And that togetherness is really encouraging that voice. Now, the other thing is that I think there's going to be people out there who want to demonize this, that they're going to say that these truckers are the reasons for empty shelves and the reasons for inflation, and try to put things onto this movement. Would you agree with that?
I would agree.
Are you already seeing that?
I'm already there, yeah.
So I want to push back on that a little bit to say that's not the case. The government chose to lock everything down time and time again and move the needle back and forth and keep moving the goalposts. And they're the ones who put the printing presses into overtime. And what got fixed? We talk about it every week on the show. Where did all the money go?
Where did the money go?
Where did the money go? Right? No wonder people are distrustful of the government. So the other thing is also that there is a global response to this, which is amazing. Again, most people, they're watching mainstream, they don't see it. We're on some of the alternative places, whether it's on Rumble or Telegram, and you can see what the world is saying, and they're really excited by what the Canadians are doing. Super excited, and it's getting incredible time. Like, Fox is talking about it, but my wife, who speaks to her aunt in Boston, her aunt just keeps sending her stuff about this convoy. And so it really has gone global. It's igniting more than just Canadians in that sense. Now, my other note on this is that it's showing that because everyone's coming together on this globally, it's also showing that globally trust in governments is at an all-time low. I do believe that this means different things to different people, but one thing is for sure, that everyone who is taking part of this is in unison as a Canadian.
Right.
And that they are all feeling, to some extent, whatever their reason is that the government is out of touch. And that it's interesting now that the Prime Minister is hiding, essentially. Yeah. And that does say a lot about the panic that's setting in on this. What are some of your thoughts on it?
Yeah, it's definitely the fruit of years of pressure. We've been through so much pressure as Canadians, as citizens in the world, being pressured into literally the corner. And when you corner citizens, we band together. And this is a time in society, in the world, that it's a very refreshing thing that we can actually unite on. Even uniting on what the Premier Doug Ford mentioned a few times, how important the truckers are, and how how we should be honoring and thanking the truckers for their duty and for their work. So we stand on that, and you definitely have to be in a place of gratitude and being thankful for everything that we have, including the food that we have to eat, the freedoms that we have. And this is certainly a very refreshing time. It looks like it's going to be escalating over the weekend. I have some friends who are actually in the forest who are going to Ottawa, so our thoughts and prayers with them. And we don't want this to turn out like another January 6th, where there is a lot of agent provocateurs and behind the scenes wolves in this. So you have to be very wise in this time, and obviously anti-violence, number one thing. We don't condone violence here at Guildhall. This is not about that. It's just about freedom and standing for our rights. And we want to see where this goes.
So, look, it's a great movement. We're in support. Let's move on to the Fed. The Fed is trapped. They, if they raise rates, they'll kill the economy. If they go the easy way out and print money, it's going to print the dollar into oblivion. Agreed?
100%.
So that's another big one. Jerry, you've brought some quick news on what happened at the Fed this week.
So the prospect of the Federal Reserve rate hike continues to rattle Wall Street. On Wednesday, the Central Bank of the U.S., the Federal Reserve, and Powell signaled that it will raise its benchmark funds rate for the first time in 3 years, likely at its March policy meeting. Many folks thought it would actually been on Wednesday, but they balked at that notion. But policymakers noted that inflation is running well above the target, and also claimed a strong labor market justifies a degree of monetary tightening. And here's a quote from Jerome Powell over that meeting. He says there's quite a bit of room to raise interest rates without threatening the labor market, he said. And he also added wages are moving up at the highest pace they have had in decades, but this is false. Price inflation overall is moving up at the highest pace in decades. This is true. This is fact. But wages have certainly been rising in nominal terms as well. But in real terms, wages are lagging behind. The Labor Department in the U.S. reported early this month that average hourly earnings for all employees decreased 2.4% on an annual basis through December when adjusting for purchasing powers. So in other words, wages aren't keeping up with inflation, so it's hitting us. It's hitting the everyday folk here.
Yeah, there was a video I was watching that was showing from a Fred chart from Rafi Faber. He does a weekly report. It's fantastic on Arcadia economics, showing about the dollar was being printed at a rate of 12% a year, and over the last couple of years, $8 trillion went directly through payments to consumers, not banks. And this is on the Fred charts that show what's going on at the Fed. So this went directly into consumers' banks, which means, of course, prices are going to rise because they're not going to go into the stock market with that. They're going to buy food and those such things. So that's part of that. Now, here's the thing that we need to watch over the course of this year. Last year, the Fed got it completely wrong that inflation was transitory. They got it completely wrong. Mm-hmm. So why are we going to believe that all of a sudden they've got enough runway to raise interest rates, to lower their balance sheet without things going really wrong? We have to wonder what will happen when the taper doesn't work, and what will happen when these inflation rates don't work.
We have to go there.
People think that, no context to anything, gold sucks, it did nothing last year. Okay, but don't forget, there was a whole year spent on saying inflation was transitory. You just hold on. Now that's out the window. And now it's, okay, Fed, let's see what you really can cook. What can really happen. Right. Now let's see what gold does, which, by the way, was up something like close to 50% or 45% over a 2-year period, and it only gave back 4%. So Fed's trapped. That's a problem.
Yeah, it's just rattling everything right now. So as we're seeing a big pullback in the metals markets, the only thing up right now is the U.S. dollar index. Everything's getting hit and getting rocked. and heading into bear territory, it looks like, for the stock market. The Russell 2000 erased all gains from last year. The S&P and the Dow Industrials go from correction to collapse right now, especially when measured against real assets like gold and silver. Although gold and silver right now haven't yet posted any big gains in this type of environment, they are significantly right now outperforming the stock market so far this year. So we got to keep an eye on this. Definitely short-term stuff, but we have to refocus on the medium term. That's for sure.
And also, in over the course of this week, anyone watching the prices of gold and silver have seen that they are down. They have been moved down into options expiry, which happens, I guess today is the last day, being Friday, as we record the show. I would kind of tend to like to call this show How I've Learned to Stop Worrying About the Dip and Love the Panic, Jerry, because
that's right.
Anyone who's been in this market long enough knows that these are panic moves to try to get this price down below a certain level so that they don't end up on the wrong side of their short position in these markets. So paper smash, okay, it didn't change the physical market because physical premiums continue to rise. We're seeing backwardation, which means the future price is lower than the price today. That's showing a lack of physical supply. And there's been huge inflows into the gold and silver ETFs. In the gold ETF alone, there was 1 million ounces in 1 week. So ask yourself, why are inflows up while the price is down? Don't panic. Buy the dip. There is a limit to this because this is a physical market. It's not equities. Gold and silver can't go to zero. The number 18778-SILVER, the website guildhallwealth.com. Stick around in the next segment. We're going to talk about a Globe and Mail article that he says why I just say no to gold and crypto. Let's find out what his reasons are and see if they make sense. The number 18778-SILVER, the website guildhallwealth.com. It's AM 640. This is The Real Money Show, and we'll be right back. Welcome back to The Real Money Show, the number 18778-SILVER and the website guildhallwealth.com. If you're looking to acquire some physical silver or gold for the first time, please go to our e-store. It's guildhallpreciousmetals.com. That's guildhallpreciousmetals.com. You can pick up tube of silver maples, a 10-ounce bar of silver, kilo bar of silver, some 1-ounce bars of gold if you'd like. It's a great place to start, great place to get your feet wet. Acquire some physical, get it into your hands, start to understand that this is an actual asset. It's real money. So, Jerry, a friend of mine sent me an article this week that was written by John Heisel at the Globe and Mail titled, Why I Just Say No to Gold and Crypto. And it came out on January 21st. Juicy article. I brought it to your attention because I thought this is a great pushback article. So let's go paragraph by paragraph and see what he has to say. And let's get the opinion of the gold guys. Now, first, let's give a little bit of background on John Heisel. He's a journalist, right? He has a master in journalism. And he has his, securities license? Is that right?
Yeah, the Canadian Securities Course.
Okay. So, and he has a book that he sometimes makes public, I guess. Mm-hmm. Is that something like that?
And
right?
he's a dividend portfolio that people track.
Yeah, he's a true kind of equities investor person.
Dividend stocks,
okay.
Yeah.
Here we go. He says, I constantly hear ads on the radio suggesting that investors should buy gold.
Radio.
Well, maybe ours, maybe not. Especially in uncertain times. What do you think is a prudent amount of gold to hold in your portfolio? His answer, I'm not a fan of gold for a couple of reasons. First, it generates no cash flow, which makes it inherently speculative. Okay, hold the phone. Let's just talk about that. Jerry, gold generates no dividends. Why?
Because gold is money, so that's what you get when you convert out of currency into another currency, like a hard asset like gold and silver. They offer no yield, but what it does offer is zero risk. It's a zero risk asset. So it was classified by the Basel III rules out of Switzerland, BIS, the Bank of International Settlements, that has reclassified gold to become Tier 1 capital, which is money, equals zero risk capital.
I love it. For me, I'm the same way. At the end of the day, anything that gives you interest or dividend means that there's a counterparty risk. It means that you are an investor. Gold is not an investment. Gold is money. That's why it doesn't pay a dividend, because it is low risk. Think about stocks. The lowest risk stock has the lowest dividend. The highest risk will have a higher dividend. So just follow that way. If you have cash in the bank, you're getting an interest rate of less than 0.5%, less than 1%. So with gold, yes, you don't get a yield because it's money. It's not a fiat currency and there's no counterparty risk. Now, he goes on to say, the only way to make money on gold is to sell it to a greater fool who will pay you more for it.
Greater fools.
Greater fools. I didn't know that central banks, now we often criticize the Fed.
You have to.
I will say that. But central banks have been net buyers of gold since 2008.
Why?
Why?
Why.
Are they all just fools? Are they all just buying a relic? Why would they own these things?
Well, the U.S. owns approximately, unaudited, of course.
Since what, 1952?
That's another topic. 8,000 tons of gold, and they hold it entirely outside. And this is physical. We're not talking about proxy. Physical gold entirely outside of the banking system. The purpose of why central banks need gold is two things. They need the ease of global liquidity and independence from currencies and financial institutions. So when you have gold, you do not have an issue of illiquid markets. Gold, market cap wise, it is number one globally. Largest market in the world. You will never have an issue globally. Transparent prices traded around the clock across the world's financial hubs, from Zurich to Switzerland to Australia to New York. It's traded around the clock. And you're not going to have an ice nine event when everyone tries to head to the door with the best stocks. You can't get out of the stock market. With gold, you'll never get caught. You're never cornered. He who has the gold makes the rules.
Yeah, I think when there's a panic in the market, that's when you find out, do you really own something or not? And if you have stocks, they can go to zero. We've had gold funds that went to zero.
Default.
They just said, we're going to give you the cash. But in the case of physical gold, it doesn't disappear. The other thing I find interesting just on the very first portion of this article is that he's drawing this comparison of it's gold or nothing, equities or nothing. Like there's no room to diversify, right? Which is what gold is all about. The idea is to have something that is negatively correlated to the dollar, and all of your equities are positively correlated to the dollar. So it doesn't matter how much you're diversified in a stock portfolio. If you don't have something that's negatively correlated to the dollar, you're not actually truly diversified. So I find it interesting that he's kind of drawing this, sort of quietly drawing a line that it's either gold or nothing, right? It's very extreme.
It's dangerous.
Let's move on. Second, John Heisel goes on. And by the way, I don't have anything against John Heisel. Good guy. His portfolio is probably amazing, but we're just
Very
pushing
smart.
back on the particular comments on gold. Second, gold has, as he says, has been a lousy long-term performer. Now, this is where it gets very interesting, and I don't appreciate the cherry picking. For the 10 years that ended January 20, price per ounce rose 10.6% in US dollars, or just 1% on a compound annual basis. After adjusting for inflation, gold's real value has fallen over that period. In fact, it's lower today than it was back in 1980. Okay, here's the thing. Gold over the last 20 years in Canadian dollars is up 400%. Average, that's 20% a year. In the last 20 years alone, gold has had 4 down years. Only one was double digits, and the other ones were quite small by comparison. So if I'm going to hold an asset whose on whole goes up every year and multiple double digits at that, I would have to say that someone cherry-picked these numbers. And of course, if I only bought gold at the very top of the market in 2011, which was a very narrow window over a 20-year period, then of course I could sit here and say, well, if I bought it there and I'm holding it today, I'm down. Well, okay, but not in Canadian dollars, because let me tell you something. I bought gold at the high in 2011. It was trading at $1,900 an ounce, and we were at par. And today, the price of gold in Canadian dollars is $2,300 an ounce. So this is cherry-picking numbers to make gold look bad. And again, if you've been holding gold for the last 20 years, you're up 400%.
And you know what? This type of narrative, I mean, smart guys, diversification is the name of the game right now, especially when we have the scenario coming up. We're going to be facing 3 or 4 interest rate hikes. And gold investors do not fear these hikes. As we mentioned the last week on the show, gold goes up during interest rate hike cycles, and even when they fail, when they start dropping interest rates because of the policy failure, gold then continues to thrive in price. But the bottom line is investors who are well positioned in hard assets really don't fear the Fed policies. But those who cling exclusively to dollar denominated financial assets like these, they should be very afraid, Jeremy.
Okay. Let's keep. I agree. By the way,
thank you.
I'm just eager to move on and
we have to. We have a lot of stuff on our desk.
So next section, gold's supposed value as an inflation hedge and safe haven in times of turmoil are common reasons people cite for buying it. Yes, I would agree.
Sure.
But the facts tell another story. Even during a pandemic, and with the U.S. economy currently experiencing its highest inflation rate in 40 years, the price of gold has basically flatlined over the last 12 months. Again, John, thanks for cherry picking those numbers. I'm gonna push back on you a little bit on that, because in 2019, I'll give both Canadian and U.S. numbers. In 2019, gold was up 13%, which was way beyond inflation. In fact, you would have to go all the way back to 2013 before you saw a down year in gold in Canadian dollars. And every year after that, you had 5 years of single digits, which were above inflation. Then you had 13% in 2019, 22% in 2020, and the market only is off 5% off of that. So you have a 35% increase over a 2-year period. We're only a month into 2022, and a 5% pullback. Yeah. I would say 35% over a 2-year period definitely beats inflation. Now, here's where he's dead wrong. You don't buy insurance after the fire. You have to have it before the fire. Case in point, Brexit. In 2016, gold went up 30% in British pounds. Mm-hmm. Gold didn't go up. It's that the pound lost 30% against a basket of goods. Mm-hmm. Now, you didn't wait till the Brexit vote came through to then buy gold.
No.
You either
Absolutely
owned it or you didn't. You either had insurance or you didn't. Now, if you were holding insurance for the last 5 years, 10 years, 20 years, you're ahead on inflation. Mm-hmm. So it's done its job.
Right.
If you had gold in 2016 in British pounds, you maintained your purchasing power. If you've had gold for the last 2 years, guess what? You've maintained your purchasing power. Now, if you're going to try to guess the market and figure out when to get on the gold train, then yeah, you could probably draw a case that this would be a losing game.
And it's a matter of being diversified. I mean, we talk about insurance. There has never been a more important time to have wealth insurance than today. We have so many geopolitical risks. Part of the reasons why certain entities are buying gold is for black swan events. You never know when that Brexit can happen. You never know when that war can break out, potentially in Russia and the Baltic region or around the Middle East. But I digress. This is not a time to not be diversified. This is diversification 101, to be a negatively correlated asset. But inflation, it was a topic that started really to become the major headline a couple years ago, and which put me on a journey to what are these financial planners? Because it's very important for me to not just listen to the gold guys as we're batting this article and John Heisel's work. It's not a matter of that. We really appreciate the work, and especially
we're not criticizing his ability to perform and make money in the market. We're simply pointing out that his attitudes towards gold are inaccurate. Mm-hmm. And a lot of his facts are inaccurate. And there's some cherry picking going on to make gold into a bad light. And so we're just pushing back on that.
And so does Seth Levin. He's a CFA, so he's a chartered financial analyst. He did an article last year on how gold has, quote unquote, lost its inflation luster. And he started off by saying, the changes in gold may have happened because of the type of interest rate environment we're in. For example, he mentions Artemis Capital Management, a study that found that gold has outperformed the stock market on a price appreciation basis over the past 48 years since Nixon delinked U.S. dollar-based convertibility in 71. Their ideal portfolio contains an allocation of the barbarous metal due to its large uncorrelated return. He writes, gold also plays a store of value role in portfolios, performing best when, and this is the key here, when real yields are negative and declining.
Jerry, let's keep on this topic because I think this is a great way to help people understand that this isn't gold versus equities. This is about how both can work together, but ultimately that gold in many ways is obviously misunderstood, and that it shouldn't be something that is seen to be as negative, that it can be a positive thing as part of your portfolio. So the number 18778 silver, the website guildhallwealth.com. It's AM 640. It's the Real Money Show, and we'll be right back. Welcome back to the Real Money Show, the number 18778 silver, and the website guildhallwealth.com. Remember, if you can't hold it, you don't own it. And we're talking about an article titled Why I Just Say No to Gold and Crypto. This came out in the Globe and Mail. And just before we went to break, Jerry, you were talking about how gold works in a portfolio coming from a CFA versus this journalist, which just has a securities license. Why point out that difference?
Well, for those in finance know the difficulties of achieving the CFA charter. Becoming a charter holder is a very difficult pursuit. A lot of people fail. A lot of people make it. So I found Seth's work at integratinginvestor.com very helpful. He holds a Bachelor of Science degree in mechanical engineering from Cornell, and he's a CFA. So he's a great writer, and he talks about the view of how gold has changed versus inflation. It's not a perfect correlation, which is some writers like John Heisel point out, but it has changed throughout the years, and how it performs today. It performs when real yields are negative and declining. A real yield is an asset's return excluding the impact of inflation. It's commonly calculated by subtracting the inflation rate from a notional government bond yield. Negative yield implies that this return is an illusionary on the stock markets, on the stocks. Inflation is eroding investors' value, he writes.
So in other words, what we're talking about is saying if the government says inflation's at 4%, but real world inflation is at 8%, nominally you're losing 4%. Mm-hmm. And so you have to be gaining at least 8% to just be zero.
To break even.
Right. So you have to be making much higher gains than that over a period of time, dividends included, to be breaking even with real world inflation.
Yeah, and the CFA writes further, just to close out, many people invested in gold for its inflation protection benefits. History is riddled with governments inflating their currency for personal gains. Gold ownership has been a dependable defense against such thefts. And he writes, to conclude, gold still enhances investment portfolios. It has some price volatility, but uncorrelated returns, which are attractive features to some. And it still protects against inflation by virtue of its utility value as money, jewelry. And in his opinion, he has identified, even though how gold has changed its inflation protection, he, quite frankly, realized that his investment thesis was antiquated, and now he can see how gold can make his and his clients' portfolio shine. So contrasting these two financial professionals away from the gold guys, I mean, it's nice to hear from us, but at the same time, we have to couple it with the mainstream, with financial guys, and this guy has it head on.
So you have two financial guys, one's pro gold, one's anti gold. Let's continue with this article. I think this is also another interesting point. In the article, quote, yes, there are periods when gold has shined. Anyone can spot these rallies in hindsight by looking at the gold price chart, but good luck identifying them ahead of time. The same goes for investing in Bitcoin or any other myriad of cryptocurrencies that are now being hawked on TV commercials during hockey games alongside, not coincidentally, ads for sports betting sites. Okay, here's something interesting. First, I'm going to break down this paragraph. First, the natural connection of comparing gold to cryptos. Okay, cryptos did a whole lot of appropriation at the beginning, right? It's mining, it's coins, right? Mm-hmm. And all of these type of things. They actually pictured a gold coin to represent crypto. But at the end of the day, look, there were lots of bands out there that had mop tops. It didn't make them the Beatles.
Yeah.
The difference is that you can bury an ounce of gold in the ground for thousands of years, pull it out of the ground, and it's still the same thing. You can melt it for very low cost and change it into something else. Cryptocurrencies are not considered money. They're considered currencies. Money is a store of value. Currencies are what you use to buy different goods, right? It's a method of exchange.
Yes.
So there's a difference there, but I think he got caught in the trap of comparing the two. Now, what's also interesting as well is this idea of drawing this concept of being lucky to identify when the market's going to move. Well, is he buying and selling every day? Does he hold Brookfield assets as an example, and he buys and sells it and waits for the big move?
No.
I doubt it.
No.
I bet he's holding on to these things for a very long time and perhaps buying on the dips to improve his position. And then maybe once it's moved quite ahead, maybe he's lightening up the load, right? But I doubt he's speculating in that sense. Maybe he's got a portion of the portfolio that he does that with.
Maybe.
That's
yeah.
a great idea. Hey, I'm going to do some fast trades on this. But that's not what gold is. Gold is something that you should always have 10, 15% of hold of. So that if the market dips, you do buy more. If the market goes up, you lighten the load. And if you're just sticking with the 15% of your portfolio, then if gold doubles in value, then you have a reason to sell. And if the price goes down, you have a reason to buy. What do you think, Jerry? Do you think this is just, is gold just a matter of luck?
Absolutely not. It's not a matter of luck. It's a matter of being prepared. And historically, gold has been that asset class that you just pass on. And our clients want that. They want to be able to own something that is tangible and easy to pass on privately. Privacy is a very important topic that comes up a lot with us, and we understand it very much so. We are, encroaching, and we are seeing and we're feeling the encroachment left, right, and center, Jeremy. And to have something that you can simply pass on, even sell, and buy, drop of a phone call, you won't have any issues. But the relation between Bitcoin and gold, I think it has proven itself to be two different things. So, despite, I do believe that there is a future on the blockchain. What it looks like it's going to be different. The IMF came out and started warning that this crypto route could lead to a systemic risk and a systemic crisis. And in times of systemic crisis, you need to have that uncorrelated asset, and that has to be gold. And,
the fact that he's drawn this comparison to one that gold has an intrinsic value. Again, bury it in the ground thousands of years, pull it up, it's the same. Right? That's money. That's intrinsic value. The fact that you can do things with it, et cetera. Crypto, no, its value comes from people believing in the value and the working of the system, right? People being on the network. But the fact that they've confused the two is something that I think a lot of people have confused. And we don't know, gold has 1,000 years of experience of hedging against inflation, and cryptos have yet to show that. So, in our mind, one's a currency, one's money. Gold can be a currency, but it's more used for store of wealth today as money. And, currencies have their purpose, and cryptos are outside the purview of central banks. And I think since everyone is very low trust of governments and banking systems, that there becomes a use case for that. We'll see where the prices go. The number 18778-SILVER, the website guildhallwealth.com. This is The Real Money Show on AM 640. We'll be right back talking about how to get involved in the physical metal market and also dealing with some Q&As from clients and people interested in getting in the market. We'll be right back. Welcome back to The Real Money Show. The number 18778-SILVER and the website guildhallwealth.com. Okay, so you're listening to the last segment and you said, you know what? These guys have a point. Maybe I should have some physical precious metals in my portfolio. But what we do is much different than if you were to buy an equity version of physical gold, whether it's a gold-backed fund or a pool account. Jerry, can you explain the difference between what we have within our registered accounts versus if someone were to just buy like an ETF or something?
Right. So it's direct ownership. And what that is, it's applying the ownership. Just like a vehicle has a VIN number on it, every single bar that is put into these accounts have a serial number on it, a very unique serial number. And what we do is we title that bar, specific serial number, to you, the owner, not to us, not to any trust, not to Questrade, not to Guildhall. It's directly to you. So that is direct ownership. And you can go visit that product. You can audit that product. ultimately you can take delivery of it. So that is what we do. And again, we believe in allocated segregated storage, fully insured, underwritten by Lloyd's of London. So it's safety. The safety is assured. Liquidity is assured. But what is also assured is often overlooked, is that we hold the gold, and we don't believe in holding the gold in the bank, because it should be independent from the banking system and the financial system. It needs to be decoupled and independent from that. So we hold it entirely in a depository, similar to the way of the U.S. holding their gold at Fort Knox or West Point without the military.
So someone would come in, we would help them open an account with Questrade. They would be the custodian of the registered account, so they would be the ones issuing your tax receipt if you're making a contribution to your RSP, those sorts of things. But when it comes to actually purchasing the product is purchased through Guildhall, held in a vault outside the banking system, and held independently in the client's own sub-account.
Right.
Now, Jerry, two questions. One, can they just take their product home? Or also, if they decide to just close out the RSP, can they just take their product home?
Yeah,
so
sure.
one, can I have an RSP but store the product on my own?
No, unfortunately not. It needs to be held in an IROC approved vault, a vault that is approved to hold assets for registered plans in Canada and IRAs in the States. It has to be approved because simply there is no way of controlling. I mean, the CRA wants to know where these assets are, and there's nothing that will stop you from giving it away or selling it on the street. So you need to have it in an approved vault. So no, you can't take it home, but you ultimately can. You can if you decide on, you know what, I'm not feeling these RSPs. I want to have my gold home. I'd rather pay the withholding tax now and worry about gold going up in the future. We have clients that are taking delivery, yes.
Yeah, so, and then the way that works is that if you want to take delivery of your physical gold, if you're not at the point where it's converted to a RIF or a LIF, which is an income fund, then withholding taxes would apply. And you'd have to pay those withholding taxes from within the account, but then you could remove the product, quote unquote, in kind. So you would remove the value in the form of the physical product, and you would get delivery of that and take it home. So it's your product, you purchased it. If you decided to pay withholding tax, you could take delivery of that physical product. If it's in a TFSA, there's no withholding tax. So if you decided at some point down the road, you know what, I own this product, I own these, this 1,000 ounces of silver, 10 100-ounce bars, or I own this 15 1-ounce bars of gold, here's my serial numbers, and I decide I want to take it home, we would provide a letter of direction. You'd sign the letter of direction. We'd submit it to Questrade, and then they'd send you a quote for what it's going to cost to ship it. And then you would get what you receive would be the bars with those serial numbers on it, and that would be that. Mm-hmm. So you could take delivery of the physical product.
Now, why would people want to be, at this moment in time, take delivery of their gold, Jeremy? What are you experiencing these days?
When it comes to the TFSA, we've only had a handful of people take delivery from the TFSA, and it was usually people who liked the idea of the TFSA at the beginning and purchased a small quantity of metals, but then decided that, you know what, I kind of went backwards. I should have started small and then built up to the TFSA. Okay. And so they thought, you know what, I can store this amount at home, right? So I've seen that. There were two clients when COVID first hit in March of 2021. No, 2020. Thank you. And where the panic set in, right? And they just thought, you know what? I'm happy to pay the government. I want this product in my home, or in my own storage, self-storing. And we got it done. Even with all the restriction and everything that was going on, it took about 2 weeks to get the product from the day we decided to make the move to them receiving their product. And so it was a bit longer than maybe usual, but still within 2 weeks they had the product at home. So we haven't seen, people don't really do it. But you know what they do, which is really exciting, is the RIF and LIF withdrawals. So every year when you have to take out 5% tax-free, a lot of people are deciding to just remove the product in kind because they're not ready to sell it at this point.
Yeah, absolutely. It's such a good opportunity, I think, even to hold the gold. Of course, you don't want to sell right now. This is the beginning of a new bull cycle here. And, for especially those clients who are, 40, 50 years old, they're going to be becoming a RIF in about 20 years. do you really want to take Canadian dollars or any dollar in the future? What does that really look like? So you're guaranteed the gold in the future. You can even request, I want to take bar number XYZ, and you're getting that bar. So it's very specific. I have a client taking delivery today for his RIF, so he's very happy to be able to do that.
Yeah, December and January is very busy with the RIF withdrawals. Okay, let's talk about institutions. We're starting to see some heavyweights going heavy on gold.
Yeah, absolutely. Just yesterday, legendary billionaire co-founder of the $65 billion hedge fund GMO has come out calling for a 50% crash in U.S. shares. And Goldman Sachs calling trouble ahead and recommending gold as a key investment right now. You heard it, Goldman Sachs. Now, who is this legend? 83-year-old Grantham last week came out saying he expects the S&P will plunge by 50% and no amount of Federal Reserve intervention could prevent it. The horse has bolted. He believes the U.S. now is in the midst of its fourth ever super bubble, joining 1929, 2000, and 2008. And also, Wall Street giant Goldman Sachs has just come out bullish on gold. They actually revised their gold forecast from about 2050 to 2100 to 2500 for the safe haven metal.
And they're always very, very conservative on those numbers.
They always lowball. They need to keep the money in the institutions, so they want people fleeing the institutions like what we're seeing today. But these are really big in times of this, this knee-jerk reaction in the market. Metals go down, everything's going down very temporarily. At the same time, Goldman Sachs is revising upwards, and I definitely am going even more bullish on gold more than ever before.
I truly believe this pullback in the market is panic. They're trying to get out of the short positions. This is the perfect time to buy. The physical market is super tight. Premiums are rising. The market is going to explode. It's only a matter of time before people stop believing the new narrative on the Fed. And at that point, people are going to be moving into precious metals in a huge, huge way. The question is going to be, will it be available? Give us a call, 1-877-8-SILVER, the website, guildhallwealth.com. My name's Jeremy Wiseman, joined by Jerry Karai. It's been great to speak with you this week. Can't wait to speak to you again next week here on The Real Money Show on AM 640 Toronto.